Thank you, everyone, for the interest in this. I really appreciate it. I'm going to spend some time framing this issue because I want to point out that it's an area that, from a Man Group perspective, I think it's interesting to sort of recognize that we're coming at it in sort of think about a 5-lane intersection. We have two very different systematic businesses. We have a discretionary business, a private markets business, and a fund of funds business. And often, while there might be a unifying approach to responsible investment, there are very different approaches and expectations for what ESG represents, particularly from a fundamental and a quant perspective. So I'm definitely going to spend a bit of time sort of talking about the philosophy of the way that we're sort of thinking about this. One of the slides I like to open with is this came out from IP magazine a while ago, but it sort of points out three issues, two of which I'm going to address in this presentation. The first one is demand for these kinds of strategies, where it's coming from. I won't address that. The second one is ESG strategies. What do we mean by that in terms of defining that? It's a term that we use that often conflates a number of terminologies. And as you've heard from others today, there are many different approaches to defining that, particularly from ESG data providers. And then third is this assumption that what we've produced drives alpha. How do we demonstrate that through the evidence? What caveats do we have to use to frame what we've produced? And is it actually the most valuable use case in what we're producing? So where I'd like to start out with is this sort of hierarchy of data. Where I'd say we as an industry have actually done a pretty good job are in those two middle quadrants. We are increasingly better at organizing information. That's not only at the legislative perspective through things like the Non-Financial Reporting Directive in the EU or standards or frameworks, but we're also getting better in terms of contextualizing this, most notably through ESG data providers. Obviously, there's some problems in terms of approaches there. Where we have not been great as an industry are the two areas on the top. One, the ether of ESG data out there, the unstructured and alternative areas, whether it's Glassdoor or looking at the frequency of words in company reports or 10K filings. And obviously, there are a lot of strategies that are starting to emerge around machine learning, artificial intelligence, and natural language processing that are incredibly interesting. But as someone who is interested in quantitative approaches, one thing that you have to ask yourself is, where do you enter within this stack? Do you start at the top, scraping data and trying to divine something meaningful out of it? Or do you start in the middle and sort of work yourself down at the bottom towards this sort of signal, this sort of golden promise of trying to create something predictive, not necessarily about alpha, but maybe about risk, right? And so where's your starting point? And then the second big question that you have to ask yourself is, what are you solving for? Again, through a number of these presentations, we've talked about alpha, but again, is that the most useful thing that we should be striving towards, particularly from an asset allocator, from an asset owner perspective? So I always start out trying to sort of parse where this evidence has come from. Ben had talked about this during his presentation, and I think about it from an academic perspective and a practitioner perspective. I'm on the PRI's Academic Advisory Committee, and I see a lot of great work coming, continues to come, but there's some problems with it. I mean, from a survey perspective, there's a clear bias over thousands and thousands of pieces that there's a positive linkage between a company's ESG operational performance and investment returns. The problem with a lot of this data is that on an individual basis, in any given study, it's very discrete. It might say something incredibly powerful about how a company within a certain sector, let's say healthcare, in a certain country in Latin America manages its supply chain, but it's hard to take that learning, that lesson, and export it into another region or sector, say the Japanese machinery sector. Right, so it's not generalizable, which we as practitioners are looking for. The practitioner data is improving, but it lacks the rigor, and I'm not trying to be mean, but it lacks the rigor of the academic work, but it is trying to prove, obviously, the message that better ESG driven companies are outperforming. I've cherry-picked this from Nordea and MSCI. There's a lot of other stuff out there. And this purports to say that the top quintile of ESG-rated companies is outperforming the bottom quintile. I'm sure you've seen a lot of this. There are two problems with this kind of data. The first one is, as we all know, it's a very limited time series. It only goes back to 2012. We're hamstrung by all of this. And as a quant, just to give you a sense, we work with 100 plus years of markets data. And as Ben said, we do, in fact, disagree about what value or quality or other factors or risk premia are defined as I'm sure everyone else does. The bigger issue with this is it purports to say better ESG aligned or driven companies are outperforming. How do we know, though, that is ESG? Why isn't it large companies or US companies or tech companies? And often, when you look at this, so this is our analysis with Sustainalytics and MSCI on the left. This is from JP Morgan. Factor 1 is rep risk. Factor 2 is arabesque on the right. And so when you actually look at what's driving the ratings, sort of so-called better performing ESG companies, it's in fact a lot of other things. In fact, sometimes it's as much as 2/3, if not more, other factors. And this brings sort of a really interesting sort of, I guess, etiological problem, right? This sort of problem of causality, of causation, right? How are we defining ESG and what are we using it for? The Peter Drucker saying of what's measurable is manageable, how well does that align to this? Is ESG in factor form simply a messy combination of quality and low vol or other factors or size? If it is, well, it wouldn't be that interesting because any sort of decent quant can replicate that, and then it kind of, sort of the whole ESG argument rests on the softer qualitative stewardship and engagement elements. But the question is, how does ESG exist in an isolated form with which we can use to measure performance, attribution? And this brings up this other issue of in the same light, is ESG process, or is it premia, or is it both? And by premia, I mean a factor. For the last 2 decades, I would say that generally ESG has been defined by process. We think of some of the great firms out there that are very well known for ESG practices, and they tend to be fundamental, discretionary. They tend to be driven by great bottom-up process. The problem with process is it's hard to measure, right? It's subjective. It is prone to greenwashing, particularly now when there is a very, very high degree of suspicion and paranoia around greenwashing. If you were to, as an asset allocator, and we run into this from a fund of funds perspective, if you were to sit across from a fund manager who runs a large cap Japanese value fund, you're going to meet with that manager and you're going to expect to sort of understand the returns in the context of Japan, large cap and value, and then stock specific attribution. But how do you do that in an ESG context for funds that either are labeled ESG or that are clearly sort of marketed where it's a key feature of their fund? And so that's why we, particularly at Man, sort of run into this problem of quants having this bias to say, look, how can we start to define it top down in a way that is not shaped by other factors? How can we actually start to think about it in terms of attribution? Many of you know sort of the 2 most popular types of attribution are Brinson attribution, which is generally region, sector, and stock-specific performance attribution, or risk factor attribution. And when you think about attribution, or when you think about risk in the evolution of quantitative finance, we think about proportional risk to the market, capital asset pricing model. We think about Fama-French factors. How do we think about ESG risk in that vein? Is it idiosyncratic? Is it just simply bottom up? Is it company specific, or is it top down? One of the issues when you sit with a discretionary manager, and again, we have the same quote problem with our own discretionary managers in trying to measure this. If you were to sit across from a discretionary manager who is marketing the ESG capabilities of their fund, they will typically show you their process slide, which is fine. If as an allocator you ask for more evidence, they will go back to the appendix and they will show you those infamous 3 or 4 case studies. We've all seen them. They tend to be sort of cherry-picked examples of stocks over several years with a narrative sort of overlaying some sort of performance and some iterative engagement, which is fine. But as an allocator, you've asked a question around attribution at the portfolio level because you want to understand where the risk is coming. You're trying to understand how to allocate to or against that. What you've received is an anecdote. And anecdotes are powerful, but they're fundamentally different from what we're trying to understand as an allocator perspective. You might laugh, but let me give you an example. My favorite anecdote goes, in 1921, Charlie Chaplin entered a Charlie Chaplin lookalike contest, and he came in 3rd, right? Now, what's great about that anecdote is it survived almost 100 years. I mean, I enjoy it. I've heard some people laugh. The problem with that anecdote is it doesn't say anything about his film work, and it doesn't reflect who came in 1st or 2nd, right? It's sort of empty in a sense, right? It's anecdotal. So when we think about this, Ben also showed this as well, but when we think about what the ESG problem or the disagreement in this area represents from a quant perspective, typically examples in the FT about Tesla and having very different perspectives around the ESG ratings, the fact that there is low correlations. This is our own analysis. The University of Geneva just came out with one around 6 to 8 providers that showed similar ones. In fact, governance came in the lowest because of differentials around civil and common law interpretations. But it does, this has always been an excuse for many in the industry who don't really buy into ESG to say, look, why, if there is so much disagreement, why should we pay attention? This has been an excuse to dismiss. The reality is the complete opposite is true, right? I mean, if you're an active manager and you see a lot of disagreement, low correlation, that should equal high dispersion. That is a great time to roll up your sleeves and do the work and try and sort of exploit these sort of signals to try and drive alpha and not play beta. The problem with ESG data is it's just lacking, obviously, a lot of convergence around standards. It's non-financial data. It's hard to, despite the SASB materiality maps, it's hard to really pinpoint what's important and what's not. But we think this is actually fantastic. Again, this is important for firms that are willing to invest in the resources for ESG data and do the work around this. And one thing that's sort of interesting in terms of resources, I came from a firm that was very fundamentally oriented. So I did a lot of work having run a sustainability fund around scores and sort of looking at my position-weighted scoring using ESG data providers. We're talking about a very different domain set when working with ESG data, and I'll get into that in a second. The people that we have working on this are data engineers who don't build quant factor models. They just work with data and normalize it or retrain it. And then you have quant researchers that start to build factor models, that do the research, that look at the correlations, that figure out what's negatively correlated, what's not, and how to sort of optimize that. This is a very simple sort of stylized depiction of our work for the last 2 years with a dedicated team of quant researchers under our co-CIO of our systematic business. And what we did was take 8 different vendors, having searched, looked at 24 vendors, and looked at the data and effectively rebuilt models based on the data on a number of criteria. Number one, data quality. What has the most quality? Data delivery. What is the easiest to use? Some data vendors tend to be very easy. Some tend to be hard, but there is a trade-off. The ones like MSCI that tend to have very smooth correlations that are very easy to implement into models don't have the granularity of someone like a Sustainalytics, for instance. So there's a trade-off there. Factor uniqueness. Again, this goes back to the granularity. Coverage is important, particularly from a systematic or quant perspective, where we have quant models that invest in very, very large universes, even out to the frontier markets. So when you start to lend a picture or produce a picture of what the ESG risks are for a given portfolio, what, for instance, is the coverage gap? And how do you address that through Bayesian or some other approach? Data frequency. So far, the way that we've built our models has been on fairly slow-moving data, and now we're starting to add speed to it through a number of different ways. Data transparency and market adoption. Here are a few examples of some of the data problems that we had to run into. And again, let me differentiate between sort of, I think that there is a risk when using ESG that there's this monoculture growing that is taking scores from ESG data providers and sort of applying them without doing a lot of due diligence underneath them, or at least understanding the biases underneath them. So, you know, on the top right, you have this issue around sort of distributions, spiky distributions versus smooth distributions. And within that, what certain scores mean. So in this example on renewable energy programs, 50% of this data provider within the scores had a 0 score. And in fact, 12% of those were legitimate zeros, so 30% of those corresponded to missing data. Right? And so how are we penalizing companies for missing data versus bad performers or bad behavior? Clearly, there are biases within, not just within sectors, but also within regions. There's a transparency bias in terms of larger companies versus smaller companies, which is why often when you look at the factor exposure for companies, you will find that size tends to be overrepresented. And then you find differing treatments of sectors. So some providers tend to treat tobacco pretty negatively, and at the same time not apply that to something like controversial arms and ammunition. So it tends to be somewhat arbitrary in a sense when you look at this. This is an example of what we're working on, and it goes back to, I think, where we started with this, probably like most typical quant-oriented firms, was how do you solve for alpha? How do you solve for a multi-factor, a quant fund that, frankly, you can sell more of? Through the evolution of our work over the last 2 years, that solution or that end game has become, frankly, the least interesting one out there. And I'll tell you why in a second. But what this does is shows the performance, the volatility, and the information ratio or Sharpe ratio from Sustainalytics or MSCI. No secret we've converged around them simply because they have the best coverage right now. We do use other data providers, but those are our main ones. And then the numeric risk adjusted. Numeric is our systematic business, and they've spent the last 2 years with this dedicated team unpacking all this data, retraining it, taking out the biases, finding the statistical inconsistencies within it, and rebuilding it. Now, I can't claim that we're the only ones to have built a proprietary ESG sort of model or framework. Many others have, but the acid test in whatever you build, and this is what's more interesting, I think, is whatever you build, you've got to regress out traditional bar factors, right? And if you're left with nothing, you kind of haven't really produced anything that is ESG. And so what we've done here is produced an ESG factor for, or risk premia, which has better performance, lower vol, and a higher IR. And I think what's interesting about it is for two reasons. Number one, we've got to caveat it, so it's gone through successions within our investment committee. And the unequivocal feedback is that we can't make a strong performance claim around this, despite there being persistence. We only have 8 years of data, a high degree of data. There is another data set out there that has 12 years of as-was data or unrevised data. Typically what you find with a lot of this data, if it's longer than that, in the way that companies tend to restate their earnings, you find those kinds of data speed bumps. So we're looking for something that was on an as-was or an unrevised basis as long as possible. And frankly, you're limited to around 10 to 12 years. So, I mean, the fact that we can't produce something that's backwards looking, that actually sees through not just one, but 3 or 4 or 5 different economic cycles limits our, and I think the industry's ability to make any kind of claim around alpha. I think that's really important. And when people do make that claim, I think it does a disservice to what we're trying to work towards. But what's interesting about this is, as you start to build something like this, and it starts to walk and talk like a factor, meaning it's not only persistent even over a limited time series, but it's pervasive. So it works across regions, it works across asset classes. This works pretty far deep into corporate fixed income as well as equities, less so on the investment grade, I think for a couple reasons, particularly because it's IG tends to be financials weighted versus high yield. But when you start to produce something like this, you start to get the power of attribution. So you can start to take a fund, regardless of whether it's called ESG or not, and start to do a factor attribution. And you can start to have this discussion with your investors, with asset owners who are trying to figure out how to allocate to or against this. So this is the correlation study against the factor that we've built. One thing I'd say is, over the course of this work, and clearly there are a number of other great quant firms out there, some that are doing some great work, one that has a great white paper that just came out a few weeks ago. I think this is obviously not the answer or end all. This is just, I think, from my perspective, one of the most different or unique ones in terms of measuring ESG. I'm sure there will be others, but I think that this starts to help investors, particularly asset owners, understand this idea of risk in a better way. What I wanted to conclude with was sort of bring it back to what this means from a conventional quant perspective. In the quant world, you tend to have 3 dominant approaches to introducing, let's say, ESG or responsible investment more widely into the quant world. The first one is, no surprise, some sort of exclusionary-oriented strategy where you optimize for what you're giving up in terms of factor exposure. The second one tends to be constraint-based, where you are establishing an upper and a lower bound around some sort of ESG criteria. It might be carbon exposure, it might be even sort of some ESG score by any measure. And you are trying to manage the tracking error and skewness as you target that. In some cases, it's very difficult to do. The third way is, as you start to build an ESG model, an independent one, that you think is orthogonal, so it won't work if it's not uncorrelated to other factors. Again, if it's a combination of quality and low vol, you just run into too much correlation risk in a multi-factor model. And so what this is a typical multi-factor model that we have for other factors, the way that we sort of uniquely define value, momentum, quality, and when you increase ESG, you end up getting a strategy that has a number of pros and a number of cons. So the pros on this are, you can take multiple views around companies. You can correlate maybe low value or some sort of quality company alongside maybe superior ESG characteristics. And you can assign a weight for this ESG factor. As an aside, we have 3 multi-factor models where we've actually included this ESG factor as 20% of the signal. So when quants talk about tilts or overlays, I would say this is sort of distinguished from that because you're not tilting something towards a better score. You're actually including this as a sort of a key part of the algorithm that's sort of driving the stock selection. There are some cons with this. First, it doesn't necessarily mean that you get the ESG exposure that is optically sort of best. In other words, with a constraint-based strategy, you can target for low carbon exposure and sort of achieve that through optimization. This won't necessarily do that. This is looking in combination with other factors to produce something that's optimal. And it doesn't exclude the fact from sort of bad names being included in the strategy, whereas other strategies would exclude that, particularly exclusionary. I'm going to end on this. I've seen a number of these come out from other managers, but I have to go back to this sort of saying, which is, as I mentioned, what's measurable is manageable. All the feedback that I get from our asset owner clients, everything that I've seen on our fund of funds side, seems to answer a different question than what most managers are sort of trying to solve for. And even internally, if you were to ask for some of our managers what they're trying to solve for, which is something best for their fund, something that is alpha-driven. But the reality is what asset owners are trying to solve for is how to allocate to this risk or away from this risk. How to sort of materialize ESG, or maybe it's climate risk in some concrete form. I mean, when we talk about risk in a quantitative sense, risk it's a number. It's volatility, or it's a variance, or a value at risk. But in the ESG world, we tend to abstract it, right? It becomes more of a rhetorical device. We're getting closer on the climate risk perspective, but we're very far away from it, in terms of ESG more widely for a number of reasons. So I'm going to leave it there and open to questions.
Okay, thank you, Jason.
Yeah.